So guys, it's a great time to be a dividend investor. I feel like I've been seeing so many more discounts out there lately. And in this video, I'm going to tell you about 3 of them that look like particularly great buying opportunities as we make our way into November. Real quick though, before we get to those, I want to hear from you. Leave me a comment below and let me know which stocks you currently have your eye on. I'd be very curious to hear what you guys think is looking good. And also, if you want to see how all of my stock picks in this series are performing, I put together a free public scoreboard where you can see everything all in one place. This spreadsheet tracks how all of my stock picks have done since mentioning them in these videos. And if you want access to the spreadsheet, just click the link in the description of the video or in the pinned comment. So guys, I think Mid-America Apartments flies a little bit too under the radar. This is a really solid dividend payer and it looks to be a really great company overall. Now, in case you're not familiar with MAA, this company owns and operates a portfolio of apartment communities across the United States with a focus on Class A and Class B properties in the Sunbelt region, which includes markets like Atlanta, Dallas, Tampa, and Orlando. Now, Mid-America currently owns over 104,000 apartment units, and they're pretty selective in the markets they choose to invest in. They're looking for areas with above average population growth, job growth, and household formation. And because their properties tend to be on the nicer end, their tenants are typically more affluent and work in industries such as healthcare, technology, and finance, which hopefully means they have less issues paying their rent. Now, taking a look at Mid-America's share price performance over here on Snapstock, which you can use for all of your stock research and analysis. There's a link to Snapstock in the description of the video and also in the pinned comment. I hope you check it out. But here we can see MAA has seen quite a little pullback here in the last month. The stock is down 4%. And if we zoom out looking at the year-to-date performance, that's going to leave it down almost 9.5%. So a pretty big drop this year. And if we zoom out once more over the last year, it's down just a little bit more over the last 365 days. It's down 10.25%. Still though, despite this share price drop, at least from what I can see, Mid-America is a REIT that just continues to fire on all cylinders. And historically, it's been a really solid grower. We can see that for the most part, everything is trending up and to the right. We definitely see that here in the revenue department. And the growth that we're seeing here is going to come from a combination of adding more apartment units to their portfolio while also raising the rents on those units over time. And that's going to trickle all the way down to the bottom line to the FFO per share right here, which also is trending up over time as well and growing at a pretty decent rate by almost 9% every year on average. And in case you're not familiar with the FFO per share, that stands for the funds from operations per share, which is basically like the REIT equivalent of free cash flow. And it's a pretty important metric, especially as it pertains to the dividend. Which on that note, scrolling down looking at the dividend stats, Mid-America seems to have it all. You get a really nice starting yield, about 4.5% looking at the payments over the trailing 12 months. So that's a really solid starting point. But in addition to that high yield, you're also getting what's historically been a really solid dividend growth rate. The 5-year CAGR is over 10%. So paired with an already high starting yield, I don't know what more you can ask for. And then if we scroll down just a little bit looking at the dividend coverage, the FFO payout ratio is pretty low. Looks like it historically sits at around 60%. So dividend safety doesn't look to be too much of an issue. And when you take all of these things combined, Mid-America does look to be a triple threat in the dividend department. They've got the high yield, they've got the growth rate, and they've got the dividend coverage. So with Mid-America right there at its 52-week low, I think it's looking like a great buy right now. And it checks all the boxes for us dividend investors. So what's not to love? I honestly can't believe this is my first time talking about Owens Corning here on the channel. This is another one of those under the radar dividend stocks, but more people definitely should know about this one. Now, in case you're not familiar with this company, they're a global leader in building materials, mainly things like insulation, roofing materials, and in their own words, doors that do more. In other words, if you think about your home, for example, Owens Corning makes a lot of the materials that would go into building your home. And what I like about this business is that people are always going to need roofs, homes will always need insulation and doors, and because their products are essential to construction, renovation, and repairs, they generate steady demand even through slower housing markets, which is going to show up in their free cash flow and their ability to raise dividends over time, as we'll see. This is a very impressive dividend grower. In the meantime, though, looking at the share price performance, Owens Corning has seen a really big pullback in the last month. The stock is down 8.3%, which is going to leave them down a whopping 21% just here in 2025, a really, really big drop drop. And if we zoom out looking at the performance over the last year, they're down even more. They're down about 27% here. But still, despite this drop, the Snap score is pretty decent. It looks to be an above average company coming in at about a 6 out of 10. Growth's looking good at 6.4. Profitability is a little bit low. That's definitely bringing their score down, but it's not really a surprise to see them get a low profitability score just considering the nature of their business. It's pretty much expected that it's going to be a bit more capital intensive than tons of other things out there. At any rate, debt's a 5 out of 10. We'll take that. Dividends and buybacks is 5.2, and then they have really strong returns on invested capital with a 9 out of 10 for capital efficiency. Now with that, if we scroll down looking at the growth, revenue's been rock solid. It's grown pretty much every single year over the last decade, and the revenue CAGR's really nice, about 11.7% over the last 5 years. I will say, for the most part, earnings per share has trended up and to the right. Looks like there's been a couple of tough years in here, 2020 for sure, but excluding that year, this is a really strong earnings growth chart. And it looks like 2024, they did see a bit of a pullback in earnings per share, but more importantly, in my opinion, the free cash flow per share did not skip a beat. This has been straight up and to the right ever since 2018, even here in 2024 and also in 2020, which looked to be rough years as far as the earnings per share goes. And the free cash flow growth has been very impressive, with a 5-year CAGR coming in at 17% and a 10-year that's even higher at 19%. With that though, if we scroll down looking at the debt situation, it's interesting. So for the most part, I think debt's been pretty good. Actually, looked like for a long time they were paying down debt very consistently, but then they issued a ton of it in 2024 right here. As we can see, the net debt went from 1.6 billion all the way up to 5.3 billion. So a really big jump in debt. And this happened because they made an acquisition. They picked up a company called Masonite, which is a manufacturer of doors. So in the process of doing that, they definitely levered up the balance sheet, but it doesn't look to be the end of the world, because if we compare that to their free cash flow, even in the trailing 12 months, the net debt to free cash flow is 6.3, which admittedly is a bit higher than where I'd like to see it. Kind of my threshold, the max of where I'd like to see that ratio is about 5. So it is above that, but I do think that they will bring that back down over time. Anyway, getting into the dividend stats, with Owens Corning, we're going to have a lower starting yield than what we saw with Mid-America, which may not be too surprising. But anyway, the dividend yield right now is 1.8%, but we are getting a crazy dividend growth rate. Over the last 5 years, they've increased the dividend on average by about 26%, and there's just been some incredible increases. 2022, they raised it about 35%. 2023, it was up almost 50%, and even in 2024, which based on this chart is a lower year, they raised it 14.6%. So that's pretty insane, and even with these monstrous raises, I would say that the dividend still looks to be really well covered. In 2024, the earnings payout ratio was still only 32%. And keep in mind, this was a year where the earnings per share was lower than previous years. So even with a lower earnings year, the payout ratio is still very low, and the free cash flow payout ratio is considerably lower than the earnings payout ratio. In 2024 is only about 17%. So yeah, Owens Corning is an absolute dividend growth monster. And with the share price down, almost 30% over the last year, I definitely think this is one to keep on your radar. So guys, we talked about Badger Meter a couple months ago. It was actually my top dividend stock to buy in August. And since we last spoke about it, this stock has seen an even bigger drop. Before we look at the share price performance though, just as a quick refresher, BMI makes water meters and sensors that helps municipalities track how much water people are using. That's basically it in a nutshell. Like I said, their products are mostly used by water utilities to measure usage. And while it may not sound super sexy, Badger is working with some pretty advanced technology. In addition to selling these physical meters, they also provide software and data services that utilities pay for on a recurring basis. So that's a nice steady stream of consistent income for them, and the pairing of their hardware and software in these municipalities makes BMI's products pretty sticky. Now with that said, jumping over, looking at the share price performance, this one's actually up in the last month. It's up just about 1.1%, but today, as I'm recording this, it's seen a crazy drop. It is down almost 5.4% just today, which happened as a result of the quarterly earnings they just put out, which is wild to me that the share price went down, because in the earnings release, revenue was up 13% year over year. They generated a ton in cash from operations. They raised their margin guidance for the year. And on top of all that, they raised their dividend by a whopping 18%, which was their 33rd annual increase. So all of that sounds great to me. And with that said, looking at the year-to-date year-to-date performance, Badger Meter is down a lot. It's down 16% here in 2025, and over the last year, it's still down in the red. It's down 10.5%. But overall, we're getting a really high quality company. This is the highest snap score we've seen all day, coming in at 7.7 out of 10. And from top to bottom, these scores are looking really dang good. Scrolling down, getting into the growth section, this is picture perfect right here. Everything is straight up into the right. Revenue, earnings per share, and free cash flow per share. And look at these CAGRs too, 18% for the revenue, 26% for the earnings per share, and 15% for the free cash flow per share. And since the earnings are growing faster than the revenue, we can scroll down looking at the margins, and we can see that this company is actually becoming more profitable over time. Their net profit margin has gone from about 7% back in 2015 to basically double that actually in the most recent year. In 2024, it's up above 15%. And we also see some margin expansion looking at the free cash flow margin. 10 years ago, it was 4.25%. In the most recent year, it's about 17.2%. So all of that's looking really good. Furthermore, if we scroll down looking at the debt, this company actually has negative net debt, which means that they're holding more cash on their balance sheet than they have total debt. To me, that's a great sign. That's actually one of my favorite things to see in a company. It just means debt is one less thing you have to worry about. And I guess the one blemish for Badger Meter, I don't even know if it's a blemish, but I know some of you guys will be turned off by this. It's the dividend yield. This is going to be by far the lowest of the day, coming in at 0.7% in the trailing 12 months. It's a little bit higher if we looked at the forward dividend yield. I think it's more like 0.85 or maybe even 0.9%. Along with that, though, you are getting a really nice dividend growth rate. Over the last 5 years, they've increased their dividend by about 15% on average, and they're actually a dividend rocket, which is a term that I use to describe stocks who are actually increasing the rate at which they grow their dividends. So as we can see here, Badger Meter's increases have just gotten larger and larger over these last few years. In 2021, they raised it by 8.6%. In 2022, by 12%. In 2023, even more. And in 2024, they increased the dividend by 23%. So the dividend growth is just getting more and more aggressive. And what's interesting about that is as they are speeding up the rate of dividend growth, the payout ratios are actually coming down. So the dividend coverage is increasing even though they are making more aggressive increases on the dividend. Overall, I think Badger Meter is an incredibly high quality company, and I think it's a really solid contender if you're in the market for another great dividend growth stock. And I think the same is true for all three of the companies that we've looked at today. With that said, though, these three are not the only ones. There are still quite a handful of other stocks out there that I think you need to keep your eye on. The first of which is going to be EOG Resources, who, as we can see, is down quite a bit in the last month. The stock is down 7.6%, which is going to leave them down 13.3% so far year to date. And also this one has a pretty high snap score as well, coming in at about 8 out of 10. So very high quality company. Anyway, next up we have FactSet Research Systems, FDS, which we talked about in last month's video. This is another really high quality company. Snap score is 7.5 out of 10. They're down another 2% or so in the last month, which is going to leave them down almost 40% so far year to date. So this one's share price just cannot catch a break. Moving on to this next one, you guys have been asking me a lot about Blue Owl Capital Corporation, whether it's, one to buy or hold or sell. And I've actually been buying a little bit more Blue Owl in my portfolio. I think I've picked up maybe 10 or 20 shares over the last month, which in this time period, the share price is down 6.2%, which is going to leave Blue Owl down about 10.4% year to date. So I think it's a good time to buy the dip. Moving on, Procter & Gamble is another one that I think is worth at least keeping an eye on. The stock is down 2% in the last month or so. And if we zoom out looking at the year to date performance, it's down 7.5%. Anyway, moving on, Verisk is another one that is definitely worth keeping an eye on. The stock is down 1.25% over the last 30 days. But year to date, it's seen a pretty nice pullback. It's down 13%. And this is a very high quality company with a snap score almost an 8 out of 10. Very profitable, pretty growthy. That's looking good. Almost perfect dividends and buybacks. Just from top to bottom, it's looking pretty sweet. Moving on, WD-40 is another one to watch. I think we talked about this company maybe a month or two ago in one of these, deeply discounted stock videos, but this is a great looking company. It's down almost 5% in the last month, which is going to leave it down 16.5% year to date. And look at the snap score, guys, 7.6 out of 10. Very, very high quality company. I really like those scores. But anyway, moving on, I think Watsco is another one to watch. I've been buying this one hand over fist. It's the newest addition to my portfolio. It's down 3.4% in the last month, which is going to leave it down, looks like 18.2% year to date. So I'm really happy to now have this one in my portfolio. I think it's a great company. And then guys, I had to include Zoetis on this list. It is up a little bit in the last month, but not by much, which is still going to leave it down quite a bit so far year to date. It's down 9.6% 8%, and the snap score is just unreal. 8.3 out of 10, with actually a perfect score in the profitability department. So top to bottom, this one's looking great. But anyway, guys, those are all of the stocks that I have my eye on right now. And in this next video right over here, I'm actually telling you about 3 more dividend stocks, but these are not your average dividend payers. These are all going to be dividend rockets, which once again are companies whose dividend growth rates are actually speeding up over time. So if you're looking for some aggressive dividend growth, you're going to want to check out these 3 stocks. So click right over here to learn about them, and I'll see you in the next one.